Afternoon, folks. It's Dave Burrows. I'm Chief Investment Officer and CEO here at Barometer Capital Management. I want to welcome everybody to our Tuesday afternoon webcast. Each week, we try and go through sort of a bird's eye view of the major moves in asset classes around the world, try and suss through all the data and identify sort of the key leadership themes in the market, talk about anything that may be changing, and sort of question our current portfolio stance to say, should we be doing something different? Do our positions continue to work? And walk through kind of our thought process to help people understand why we're making the decisions that we're making. For clients, it's a great opportunity to review what's going on in portfolios. For those that don't know us, it's a good opportunity to get an understanding for how we think. Lots of different approaches out there. We have one that for us has worked quite well over time, but not certainly for everybody. And if I do my job, you get a pretty good idea as to what's driving our decision making. Always I like to start sort of from the top, and we've been in a bull market in U.S. stocks going back to the beginning of this blue zone in 2013. And with interruptions, the market has worked its way higher and largely stayed above the longer term moving averages. Bull market has been strong, but in percentage terms, about 340% since 2013 sort of pales in comparison to the full extent of the bull market in the 80s and 90s, 1,300% over 217 days. Market has come down and touched on the long-term moving average a number of times. Each time it's recovered nicely. And these are tough markets to go through. When you go through them, it's certainly nothing like, the tech wreck or the financial crisis. They happen in secular bear markets. And we've been in a secular bull market in U.S. stocks for quite some time. Now, seasonally, and we've put this up regularly in full disclosure, second half of December tends to be the toughest 2 weeks of the year. As they used to say, sell Rosh Hashanah and buy Yom Kippur. It's not been playing out that way so far. Market's been working its way higher. So really, since early April, when we saw the low driven by the tariff trade, the S&P has been working its way higher. We finally made new highs in June. And since then, day by day, we've been working our way higher. We're above the 8-day, the 21-day moving average, the 50-day, the 200-day. And there's a pretty clear trend in place. Now, a lot of folks are worried about the impact of tariffs, but we got to remember there's a lot of moving parts in the market. So while the U.S. government has taken in $94 billion in total tariff revenue since March, on the other side, they've been giving money away by the way of distribution and tax funds and tax cuts to corporations. So in fact, they've actually had more outflows than inflows from the tariffs, counter to what you might read in the press. But in the end, corporate profits have been strong. Current estimate is that U.S. corporations will come out of this year with about 9.7% profit growth, which is up that estimate over the last couple of months. Analysts took their estimates down, of course, in April and May. But as we've moved along, the negative impact has been sort of negligible. If we look at the QQQ, the NASDAQ 100, it sold off quite sharply in the spring, 25%, came back and made a new high, and it's about 11% above the level that we started at, before the tariff crunch came. And again, market's been orderly, staying above all of the moving averages. Now, we are in a market where a few companies are making a big difference. If we take the equally weighted S&P 500, it declined about 18% heading into April. It's recovered back, did make new highs, but really, only about 4% above the level we were at when the tariff discussion began. And the market is just mildly positive for the average stock in 2025. So the average stock has not fared the same way. And of course, if you're a Canadian investor looking at it in Canadian dollars, it's been almost no return because the Canadian dollar has been a little stronger. And frankly, it's the same if you've been in Europe or in Asia. US dollar has been weak on a relative basis. So that's a change because for a long time the US market was really the only game in town. And over the last number of months, we've seen a very strong rally in the rest of the world. So the MSCI All World Index has been moving nicely higher over the last 12 months. These are monthly bars. So this index up about 13% in the last 5 months as we started to make new highs. It's notable that we're making new highs because it's the first time this index has made new highs going all the way back to 2007. So as we often talk about, that puts it into a new bull market. We've exceeded the highs from the previous bull market. Now it looks as though these geographic regions start to get revalued. So whether it's Europe marching higher or Japan, notably after 33 years, or whether it's countries like Singapore or South Korea, look at the relative price performance in blue relative to the S&P 500. So today, South Korea makes a new relative high, absolute high, and a new relative high versus the S&P, better than 85% of companies over the last 12 months. Asia in general is strong. Africa, some countries in Africa particularly strong, especially South Africa with its exposure to gold and miners. China is making 3-year highs, and it's had a nice relative move over the last 12 months since last September relative to the S&P 500. And a lot of Latin American and South American countries like Peru up 35% since it made a new high 5 months ago. So for the first time in a long time, there's lots to do globally, even emerging markets. This is the PIE ETF. It's made up of leading emerging markets companies from around the world. Again, nice rising relative strength, better than 80% of companies in the S&P, and the TSX marching its way higher, especially in the last 5 months, very, very strong. So lots of things to choose from. The MSCI All World Index has, clearly made a turn versus the S&P 500 equal weight index this month, taking out all of this consolidation of the last few months, and the TSX doing the same thing. In the fixed income markets, it's been the same story for quite some time. There is concern about a second wave of inflation. We've talked about that. I thought this was interesting. This was from a piece from Apollo this past week. If you take a weighted share of the CPI components that are rising greater than the 2% annualized month-on-month rate that the Fed is looking for, over 70% of the components are moving ahead faster than at the 2% clip. So this sort of points to the fact it's very likely we start to see the inflation data as a whole pick up again. And the bond market's kind of been telling us that. Yields have been very sticky on the long-term bonds, even while the Fed has been cutting rates. And the price of long-term US government bonds has made a series of lower lows and lower highs going back over the last 5 years. So still clearly in a downtrend, trading below the moving averages. On commodities have been enjoying a great rally. It started in 2020. We went through the tightening cycle and they have been marching higher. This is a basket of global commodities, led certainly by gold, but that's sort of the long-term picture. Again, a big reversal in direction. So the last 5 years has provided significant structural shift within the market. And you really have to call into question a lot of the things that you have come to believe. A lot of people believe, commodities are really scary because they didn't do well for a decade. And gold was a serial disappointer. Now gold is up 82% since early in 2024. And when we look at some of the historical bull markets, it can run a long way. So it's currently about 68% above the 200-week moving average. In previous bull markets, the first leg has been substantially stronger. And silver is the same. Silver about 60% above the moving average and clearly in a bull market. But if we look at it the same terms, in the bull market of the 70s, 243% above the moving average, 478% above the moving average. We're currently 66% above the moving average. it's relatively muted. Even in the small bull market of the 2000s, first rally got to 76% above the moving average, 140% in the second leg, 120% in the third leg. Again, very, very early stage. Looking at it another way, if you compared it price above the 200-day moving average, silver and commodities tend to have blow off tops. In the bull market after 2000, getting to sort of 70% above the 200-day moving average in each of these recent tops, we're 28% above the moving average today. So it's kind of like the dog that chased the car. We're in a bull market now. The question is, how far does it go? Our view has been that a balanced portfolio today should not be 60% stocks and 40% bonds, but we should be hedging inflation as opposed to disinflation by using gold as the hedge in portfolios to protect against rising prices and the devaluation of purchasing power. And there's a new boss in town from a leadership perspective. Tech stocks are continuing to do quite well, but frankly, gold is doing better. This is gold relative to the QQQ. And we'll see how long this goes on for. The last bull market lasts a very long time. So moving away from gold, other commodities performing particularly well. This past week, platinum and palladium, had big weeks. Platinum broke out for the first time in about 8 years over the last 2 months. And that's on the back of a weak US dollar. So a lot of these changes have taken place because the US dollar, which had been strong for a decade, has been weakening versus the basket of world currencies. In fact, 2025 is about the worst year for the US dollar going back to 1990, so 35 years. And that has implications for global investors who have been hiding in the US dollar because it was strengthening and buying US stocks. It was the only game in town. But now the euro is strengthening and the Canadian dollar is strengthening and the pound sterling is strengthening and the Japanese yen is strengthening. So sitting in a global investor's seat, it's easy to see why they might consider taking some of those assets they were using as reserve currencies like treasury bonds and moving it to gold, or moving stocks from the US to their local markets. And at the end of the day, there is no one who has to be in a particular type of assets. In our world, our job is to find leadership. And when I define leadership, I mean sectors or themes where over time a higher and higher percent of stocks are participating or performing well. And if we look at an asset class like equities, great that the US market was performing well, we could focus there. But as the world's equity markets have broadened and more markets have started to participate, it gives us a lot of choice and ability to diversify. And so we're always looking for areas of the market that are showing expanding breadth, and that can be sectors or themes or geographic regions, asset classes. And on the other side, after you've had a long rally in something, eventually, while the leaders carry on, the weaklings will start to sell off. And that gives you advance warning if you're looking at a broad universe. If you're not just focused on the leading stocks, when the weaklings start to sell off, it tells you should be a little more cautious. And so for us, when that takes place, we raise a little cash. And of course, people know we use stop losses on our positions. If our stops get hit, we don't add any new money to a universe of security where breadth is deteriorating. Right? Our job then is to play defense. And this, I think, is something that is unique in our case. We don't stay invested all the time. We try and take advantage of strength where we can find it. We try to find diversification where we can find it. But we do not buy dips. And we do not buy a falling market. Because you can't afford to let a little mistake turn into a big one. When breadth is deteriorating, you got to be more cautious. You got to tighten up your stops and reduce your tolerance for risk. And you stop putting money to work and wait for the traffic to pass. Now, as it stands right now, our big picture models are broadly positive. The percent of stocks in the US that are performing well has been improving. And the percent of global stocks that are performing well has been improving. Still, though, less than 60%, and we can get all the way up to 70 or 80% in a bull market when everything's working and it's really easy to make money. Right now, we're in a world where you got to pick your spots. There's some great companies that are performing well, and there's some companies that are performing very poorly. And this is why we just don't think owning an index is the way to go. Now, we hone that indicator by looking at under the surface, the percent of stocks trading above their 50-day moving average and whether that's improving or not. And recently, it's been a little weaker in the US and a little weaker globally. And the percent of stocks with positive weekly momentum or upward trajectory has waned a little bit in the US. So we're being a little more cautious. Global stocks in general performing better. And frankly, the Canadian market, surprisingly, has been very, very strong. And a lot of that has to do with the sectoral makeup. So remember, our job is to identify leadership. And people are hiring us to pick our spots, to skew portfolios to the assets that are seeing net inflows, to make sure that we get in the way of those structural revaluations that take place, like what's happening right now in precious metals and some of the commodities. Our job is to adjust the portfolios when it is required, and sometimes that means play defense. So let's talk leadership for a moment. Financials have been leadership for, well, going back just about 4 years when they broke out back at the end of 2020. And these are monthly bars, and the market just slowly been grinding higher. And there's haves and have-nots. Early part of the rally was led by insurance companies. And as many know, big positions for us were things like Fairfax, which we have taken down in size, we still own, Intact Financial, some of the US insurance companies. But really we're focused now and have been over the last year in the investment banks. Now it's hard to imagine that the market gets really tough when the investment banks are continually making new highs. Morgan Stanley is an example. Now, their earnings have been driven by growth in their investment management business, but also in their trading business and their corporate finance business. But today, Morgan Stanley did make a new high, made a new relative high, and there's no signal coming from this that we should be more cautious, nor is there one coming from JPMorgan. Both of these would be in our top 10 positions. The Canadian banks, on a relative basis, even versus US banks, have been relatively improving. And this is an ETF that owns an equally weighted basket of the big 5 Canadian banks. No sign of trouble here. Global banks, we've talked about now for some number of months, they're also marching higher. So the leadership and strength in financials looks as though it continues. Not everything within financials is performing well, but certainly the big market, the big capital markets banks continue to do well. And it's relatively early days in the Eurozone financials rally. We think this can go on for years, of course, with interruptions. On industrials, well, industrials consolidated really since the beginning of June. This is an equally weighted basket of industrial companies. A mixed bag here as well. Transportation continues to have weak relative strength. So this is an area we've been avoiding. But aerospace and defense just continues to chug along. Now, we know there's a conversation going on between the US and China right now. There's some rumors that Boeing may be able to announce a deal for as many as 500 jetliners. That would be great for GE Aerospace. GE Aerospace is benefiting from a long cycle in maintenance on aircraft engines, but they do have a new generation of aircraft engines coming that are more efficient. And certainly the market is anticipating, a win here. So sloppy day in the market today, but certainly not for the aerospace companies. GE Aerospace very strong. Embraer is a big holding of ours, with revenue from around the world, but clearly a more international company. And Howmet Aerospace, which is still our third biggest position in the firm, and we've had this now for a couple of years, continues to win, making parts for jet engines and effectively the fan blades that go into jet engines, which they have a very specific process that makes them the absolute market leader. So these continue to perform well. Now, the common characteristic of these companies is that they can pass through price increases. There's so much demand for their products. When their costs go up today, they can raise price tomorrow. And we're trying to focus on companies that don't have debt, that can raise price, that have a history of raising their dividend. And that characteristic we think is really, really attractive in a world where there is inflation. On the gold miners, they're just having a dynamite year. The GDX, which is the ETF that holds gold miners, made a new high back in February, and since then is up 72%. The uranium producers, the uranium ETF, made up of the large producers of uranium. Of course, Cameco is our big holding. It's the granddaddy of the bunch. The uranium ETF's up 27% in the month of September. So clearly making a breakaway from this long consolidation. And this month, copper producers are making new highs after not making new highs for 13 years. So I think we're still very, very early days in this basic materials rally. I think basic materials are a haven where investors are going when we realize that central banks are not going to get their heads around inflation, despite some signals that maybe the Fed is being a little too easy. They cut rates this month, and it was a big green light for investors to invest in things that benefit from inflation, like copper and gold, and uranium. This is the XME ETF, which is made up of steel companies, metals and miners, and gold miners. It's up almost 14% in the month of September. So the reason I point this stuff out is very often we get stuck looking at an index and saying, well, the metals are only 2% of the S&P 500, so why bother? Well, you bother because these sectors can go from being a very small part of the market to a bigger part of the market. Energy in particular. Energy has been at times as low as 2%, as high as 20% of the market. So for the miners themselves, Kinross continues to chug higher, making new relative strength and absolute highs today. Agnico Eagle is the same. Alamos Gold is the same. We talked about this actually only a couple of weeks ago, that it had lagged, but was starting to play catch up. And it's had a really nice rally since. The uranium miners, very, very strong. And now we're looking at the picks and shovels, the companies that provide services into this industry. And in particular, we've recently put on a position in Major Drilling. Major Drilling is sort of the leader in doing development and exploration drilling for mining companies. When mining companies start doing well, the capital markets open up to them. They're able to raise money, and they haven't been able to for a long, long time because the industry was out of favor. And when that happens, they go out and look for drill rigs, frankly, to go and find more copper or silver or gold. And if we look at what happened to Major Drilling in the last bull market, it was up well over 1,000%. So we'll see. Early stage, and it's a small company, but it's a small position that we've added to our equity fund. So you would think with all the excitement, there'd be a ton of money flowing into precious metals. These are the daily flows that have been going into the GLD, which is the ETF that buys gold. And there has been flows coming in. In fact, last Friday and Monday were very, very big days. But surprisingly, in the miners themselves, it's basically been outflows for almost the entire year. Investors become hostage to their emotions, and after a long time of being disappointed, every rally has been sold with only very small inflows in. So a lot of this rally has been driven by central banks, and frankly, individual investors and investment funds have had very small positions here. My guess is that will grow as time goes along here, because these companies are making a pile of money. The difference between prices, and I showed this last month as an update because the one I had before was for gold at 3,200. Well, now we're at 3,800, but certainly the costs are not going up that quickly. So the profitability here is great, and we're going to see some very, very strong dividend growth in some of the cash flow producing companies. In energy, after consolidating for almost 2 years, the energy sector appears like it's ready to break out. Imperial has been a leader, but we have weighted up our energy position over the last 2 weeks. We talked about the fact that when these get going, they can go a long way. We added Tamarack Valley, which we talked about last week. We've added some Suncor. We've added some Headwater. And these are all companies that can really benefit from very sharply growing cash flows. And most of these companies have committed to return capital to shareholders by way of dividend increases. So we'll see. but this group certainly strengthening. Communications continues to behave well, led by companies like Google and Meta, which we've talked about a lot. Take-Two Interactive is one of the stronger positions in the portfolio, video gaming company. Technology, after consolidating, boy, it's had a great last 10 days, and we'll see. And this may be, continuing here. The semiconductors index did the same thing. And James was on just last week talking about Lam Research. Boy, what a 2 weeks it's had. And SiTime, which is a smaller company, $8 billion company selling chips into Apple for their new iPhones. So it's a great market because we really can get diversification geographically. We can get diversification by sector. It's not a market that's just dominated by 6 or 8 stocks. And those companies are doing well, but there are other things to do that maybe give us better risk reward. On the other side, we're not lugging some of the weak sectors like consumer staples that keeps making relative strength lows, utilities, which has really lagged, real estate investment trusts, pipelines. These are all things that tend to do well when interest rates are going down. They pay a high dividend, but with very little dividend growth. And we're kind of staying away from these. High dividend stocks in general have been underperforming. So dividend growth as a strategy is what we're focusing on, the income strategy, and so far that continues to chug along. So look, last week when we put this chart up, the average sector had just over 50% of stocks in uptrends. This week it's close to 52. It's improving. The sectors are moving along this distribution curve to the right. So all of the sectors in this column have between 48 and 52% of stocks within the sector performing well. Like sectors in this column between 54 and 56, in this column 58 and 62. So the further right we go, the better the breadth. And you can see it includes semiconductors, banks, precious metals, regional banks, aerospace, insurance. And at the left side, the weakest sectors, consumer staples, restaurants, that's consumer discretionary, healthcare, biotech. So as long as we're moving here to the right, that's a healthy market. From a sector perspective, not a lot changed. The one change you would see is our energy weight has close to doubled over the course of the month. And seasonally, it often makes sense to do that. The charts are supporting it. The cash flows are supporting it. And we think that we're relatively early stage here. The risk is we're too early. Financials were as high as 28% early in the year. Our insurance company exposure came down. The banking exposure remains. Industrials are significant overweight versus the S&P, just about twice the index weight. Materials are a very significant overweight, but we think it's giving us great diversification and inflation protection. Technology is a significant underweight, but arguably the companies we own are the leading stocks in the group. And at the other end of the spectrum, bonds are a very low weight, and the things that act like bonds, the most defensive sectors, the ones you would want to own in disinflation, not only aren't performing, but their earnings growth is not so strong. And so they make up a very small part of our portfolio. So the biggest changes this week would be a weighting up in our energy exposure. Largely, it's large-sized companies with great balance sheets, very long life reserves, and a great opportunity for dividend growth. Now, when we look for signs of risk in the market beyond breadth, we always watch credit spreads, the excess return that a corporate bond investor is demanding to buy a corporate bond versus a government bond. And interestingly, the spread now is lower than it has been at any time since 2007. In other words, bond investors are not concerned about not getting paid. And generally, they're one of the first investors to get concerned with risk. Volatility is well within the range that we tend to be in during a bull market. And so even though seasonally this can be a difficult time, we've let the market tell us where we should be. It's not for us to say market's wrong and we're right. Ultimately, if you do that, the market can stay irrational longer than you can stay solvent. So we're in a bull market till we're not. We really like the fact that we've got the diversification now of an international weighting. We think that that's on our side. We think that arguably that's a theme that could play out over the next 10 years. We like that as an alternative. In many of our accounts, we have our global music fund, which is just paying us copyright royalties, just about 10%. Has nothing to do with the economy. I prefer that as an alternative to a bond portfolio. And if things get more difficult, we'll get more cautious. But as it sits right now, we're getting through this difficult time in the year. We'll see. It wouldn't surprise me if we pulled back 5% at some point. But given what we're seeing in earnings revisions, it's likely that the year finishes pretty strong. And with that, maybe we'll see if we've got any questions. Okay, so the first question I've got today is from John, who asks, when companies, often retailers, report earnings, they talk about different income consumers. I understand from credit cards, they may know my wealth, but if someone pays cash or debit, how do they know the wealth of the consumer? And are they accurate in their opinion? So when the analysts talk about consumers, they look at things like credit card delinquencies or line of credit delinquencies or mortgage delinquencies. And they are rising, in fairness. But when we say they're rising, I think that in Canada, for instance, we've gone from about delinquencies of about 0.15 of 1% to about 0.4 of 1%. So yes, they are going up, but it is a very, very small, slow process. And the banks have been accounting for it well. In the US, they track delinquencies on auto loans, and they have gone up. Clearly the wealthier consumer is benefiting from what's happening in asset markets. And sadly, the lower end consumer who doesn't have assets is just paying the price of inflation. So for asset investors, we have to make sure we use our assets wisely, and we got to make sure we own assets that benefit from inflation and help ourselves mitigate those risks. From an investment perspective, you can see we don't have a lot of consumer discretionary exposure, not because we think there's a major problem, but because the market isn't giving us a reason to. And that would likely be an area that would see weakness early in the event that the consumer is getting squeezed. We are concerned about real estate markets. I am personally concerned about real estate markets because in the long term, when long-term rates are rising, it makes it very hard for real estate prices to go up. And a lot of people have used their homes as a piggy bank, especially here in Canada. So that's something that I watch. Jerry is asking about the recent drop in Constellation Software, which has been a great compounder for years. It absolutely has been a great stock over many years. The difficulty with a company like Constellation, which is a little bit thin, is when it does eventually disappoint, it can come off a lot. The multiple expands, and at some point, it doesn't take much of a multiple compression to see share prices move lower. So we haven't spent a lot of time on it. It's not a company that we own, but I do know it recently it's been difficult. I would let the traffic clear there. John says, Google, Canada collected $4.6 billion in tariff revenue in late August 25, with a significant surge in import duties, accounting for 2.8 of all federal revenue in the second quarter of the year. Well, certainly revenues are going higher on these tariffs. I think this is friction in business, and ultimately it's not great for it. It's not showing up in earnings yet, and frankly, is not showing up in margins. Typically, before you get an economic problem, you start to see margins contract, and we haven't seen that yet. We watch that very closely. We have seen some weakness in employment, and Powell made reference to that today. I think the market didn't love his comments on the recent weakness in employment. Again, that's going to be mostly a consumer issue to begin with. Lawrence is saying, I see that gas utilities is one of the strongest sectors from a breadth perspective, but haven't seen any purchase in the sector. We have stayed away largely from the gas pipelines. We do own some Enbridge. It has really outperformed the sector. Perhaps it's one that we should own more of. The characteristic of Enbridge is it's a high dividend that grows low single digits. That's not sort of the target that we're looking for right now. The characteristic we're looking for client portfolios is rapidly growing dividends, which we think would protect us against inflation. A lot of the gas pipelines in the US are master limited partnerships, which make it tricky from a Canadian investor's perspective, because there's tricky tax situations that go along with those. There's a question here on a couple of companies, Rigetti and D-Wave, which we really don't cover, so I won't make any comments on that. That's from Larry. And then Frank asks on the sector breadth chart. Oh, it's the same question that Lawrence asked. So, and his question was, what are some of the companies in the sector? Well, gas utility, Enbridge is probably the most obvious one in Canada, and it is chugging along. It's trading better than about 70% of the companies in the S&P 500. The one characteristics I'd like to see is more dividend growth there. And remember, we only need 20 or 30 companies in the portfolio. There's a lot of great companies out there. There's a lot of companies we don't own. But I think that the mix we have is a really well-diversified mix. I think that's all the questions. If there's questions I didn't answer today, or there's things you'd love to talk about in private, please don't hesitate to reach out. We're always happy to take a call. I get 5 or 6 calls every week after these webcasts and have great conversations. I always enjoy them. Try and make a return call as quickly as possible. And otherwise, send us an email. Happy to answer your questions. If you're a client and you'd like to have a review, we're reaching out right now, busy booking catch-up meetings. Please let me know. And if you'd like one sooner rather than later, I'll get Julie to book it up. Thanks very much for participating again this week, folks, and we'll see you again next Tuesday. Have a good week.